Y'all already know what it is. Welcome back. It's Motivational Monday. Really, really excited to be back with you all this week. It's been an amazing start to the year. We had a great call last week. I would anticipate nothing but the best tonight. We have a very special guest with us tonight, Mr. Brandon Anthony Clark himself. If you've been under a rock, this man has been turning social media over. All right, he's coming out and he's talking about principles that this group in particular have been focused on, ways to flip, to make a difference, right? So what are the things that you're already doing that you could do better to take advantage of? So tonight we're going to have a dynamic discussion with him, and he's going to do something that a lot of you have asked about: practical application. I hear you talking to me. Show me how to do it. Let me see it in practice. So get your notepads out, take copious notes. You know how we do. But before we really get this thing started, I would be remiss if I didn't yield the floor. Mr. Vassar, if you're out there, you can kind of talk about how this conversation came to fruition. Because again, I put it in the group. You Steph Curry, boy, you pull up from 30 feet. And so I know you started working with Mr. Clark. But if you're out there, James, kind of just tee it up for the group to let them know how this conversation came to fruition tonight. I'll turn it over to Cousin Ed for some housekeeping after that, and then we'll get started.
I'll be real brief, man. Got a chance to meet Brandon. I've been following him for a while, and he's just sharing great information. You know how when you hear something, it just resonates and it just makes sense. And what I realized was that many people, especially those in my circle, those who are in our organization, our community, they don't know this information as well. If I'm just now coming to it and realizing that it's something out there is not really talked about, you really have to be in the know. You're starting to hear some buzzwords like infinite banking and protecting your asset protection, but a lot of people haven't really been taking advantage of it. And so just following Brandon is how he's just breaking it down, making it very, very easy to understand. Almost where you have to pay somebody for you to make you to misunderstand this information, right? So it was just too good to be. It's like, man, this makes too much sense. And so because of that, he and I got a chance to talk a couple of times, and I'm following his program. It just makes too much sense not to. So as a result of that, I just felt like it was my duty to bring this to our community so that everybody has the opportunity to at least hear about it and understand that this is an option for you, that this is available to you and everybody that you like, love, and care about. So we asked Brandon to join us, and he was so gracious to bless us with his presence today. So that's how we came about. So I'll turn it back over to you, man.
I appreciate it, bro.
Yeah, absolutely.
It's so important that we understand the power of relationships and what we always talk about within this group. If you want to have access to Brandon and Anthony, and Brandon, I'll certainly have you introduce Anthony to the group as well. But if you want to have access to these gentlemen, this is not a fly-by-night type of thing. These men cost money. But based on the relationship, they're willing to come here and spread some good tidings and cheer with us. Why is that important? We said that the only value you really have is the value that you add to the group. And we're fortunate enough that Brandon and Anthony have a similar mission and vision. They're trying to change lives with education. It's not all about the money for them, but they are in business to make money. Now, what they are going to talk to us about tonight is how we can take advantage of some of the strategies that they've learned along the way. But before I steal any thunder, Cousin Ed, can we talk about general housekeeping for the night? And then we can kind of get some things teed up so Mr. Clark can introduce his business partner. He can take the floor.
Definitely. Good evening, all. Good evening, all. Thank you for coming back again. I want to welcome our guests. Basic housekeeping. Make sure that we are courteous to our guests. If you have any questions, please put them into the chat or raise your hand. We will have a time when we're able to come off mute and ask questions. But we're going to give them a chance to actually tell you. And tonight is going to be much different. Like he said, they're going to actually teach you how their system works. So give them a chance to show you and teach you how the system works. After that, we will have a point where we can ask questions. So please raise your hand or come off mute at that time. Also, this call is recorded, so we will have a chance to replay this. So make sure you try to get your questions in, but if anything is missed, you can catch it on the replay. Lastly, as we always do, please come off mute and welcome our guests to the call.
Good evening. Thank you so much for being here. We are
Welcome. We're glad to have you on the call
Absolutely
tonight.
welcome. Thank you so much.
Thank you for coming.
Good evening.
Yeah.
Thank you for
Appreciate
coming.
it, brother.
Appreciate
Thank you
y'all.
for
Good
joining.
evening. Welcome.
welcome.
I appreciate y'all. Hey, just so y'all know, y'all don't have to stay on mute the whole time. You know, I'm gonna ask
Okay.
a lot of questions. This is like class, you know, it's not like a presentation. This is a conversation, right? So feel free to stop me. You can slow me down. If something don't make sense, we can back up. You know, I'm here to just provide value, as much value as I possibly can. I'm extremely humble and grateful for the opportunity to come to speak with you guys because just a few years ago, I used to do these same classes on Facebook. Y'all know Facebook Live?
Yeah.
Mhm.
Back before there was Instagram Live and all this stuff, I used to be on Facebook Live with no eyeballs watching. You know, nobody really, no eyeballs watching. It was just me up with the blackboard. You know what I mean? Or not even a blackboard at that point in time. It was a dusty whiteboard, and it was the only whiteboard that I could afford. You know, at that time. And so I guess the point that I'm trying to make is that this is Motivation Monday, right? So we all start from, especially if you're trying to do something big, you just got to get it out of the mud. You got to just start from the bottom. You can't really worry about what you don't have. You just got to start with what you got, what you know, and then just start putting in work. You know, the more work you put in, the more reps you get, just the better you get, and the more valuable you can make yourself. Because a lot of times I feel like a lot of us chase money instead of chasing value. You know, and if you chase the value, then you'll get the money. You can't chase the money at all, you know? And so, you know, D said something earlier. He said, hey, these men cost money. Look, we charge because we don't charge because we need the money. We need the money, but we don't need the money. That's not why we charge, if that makes sense.
Yep.
Y'all know what I'm talking about?
Absolutely.
Yes, sir. Absolutely.
Yes, sir.
Absolutely.
All right, right on. So today, what I just kind of wanted to bring to the table, my partner, Anthony, my man, Anthony Enriquez, him and I actually used to work at the same firm together. And, you know, what this industry does, I don't know, has anybody on the call been in the financial services industry, whether they sold life insurance, done anything like that?
I'm unfortunately still here.
Still here?
Yes, sir. Yes, sir.
Right on.
Same.
Yes, absolutely. Yes.
Yes.
Hey,
Yeah,
How-
so am I.
how easy is it, or how difficult is it to make it in this industry?
I think, bro, it's a great question, but I think a lot of people take it for granted. 90% of people wash out.
Yep.
And a lot of it is mental and emotional because it takes a mental and emotional toll on you, and relationships are strained.
Yep.
Mm-hmm.
Yep. You're absolutely right. So 9 out of 10 people won't even make it out of their first year. You feel me? But I've been doing this. I'm going on 6 years now, and I met Anthony at my previous company, and him and I just had a friendship. We used to work under the same firm with the same mentors, and so him and I just used to be in the back, you know, taking our notes, you know, practicing, you know, role playing, you know, doing all that stuff that they tell you're supposed to do that you don't really want to do. You know?
Right.
We athletes by nature, so it ain't nothing for us to, you know, practice, put in reps, because we know if we put in the time, we get better. So Anthony, I'm gonna let you introduce yourself, my brother. I appreciate you for being here, and you know, all the value that you provide for me.
Yeah, Brandon's I would say the face of the organization. He's more so the guy to be out there and speak the educational part. I'm more of the back end. So tonight I'll be in the chat. Questions you guys have, feel free. If you guys aren't available to actually stop the class, just ask your questions there, and I'll be sure to address those. But
Appreciate you, bro.
yeah, we're based out of California, and that's where we met. And I don't want to take too much time talking about us. I'd rather get into some educational things that you guys can.
Right on.
Definitely
All right,
appreciate
man.
you.
Let's give the people what they want. Okay.
Yeah.
So where should we start? Hey, real quick, can you I have another device here. It's my iPad. I want it, if you can make that a co-host so I can
Yep,
share.
absolutely.
Awesome.
And unlock the sharing capabilities too as well.
Okay.
Yep.
Okay. All right. So let me see. So just by a show of hands, before we get started, how many of us have life insurance on the call today? Okay. Good stuff. All right. Greg, do you mind taking yourself off mute and sharing with us the main reason why you bought life insurance? Or actually, anybody can answer that question.
Can you hear me? Can you hear me?
Mhm.
The main reason was I learned the hard way when my father died, and what it meant to assets and being able to talk through that. So it taught me when he died when I was in the 10th grade. So I saw my family's lifestyle go down tremendously. So it taught me the basics, 1, 2, 3, and what I needed to do. So as soon as I got myself in a position to do so, I started for my family.
Right on, man. That's awesome, man. Thank you for sharing that with us. We definitely got to hear more and more stories like that. To just because I hear sometimes that, man, life insurance sounds like kind of like too good to be true or a scam. Does it even really pay out? But you know, it's one of those things to where you only you gotta experience like just certain things, right? I've had cases in my time here where I've delivered death claims to families who happened to have insurance, and then they passed away, and you're able to just give them a check. So that's something that I like to see. Anybody else want to share why they got life insurance?
In the interest of not belonging to time, you know, I'll tell the group before I got on this call tonight. I spent about an hour and a half on the phone with one of my agents, because I just had with my wife and I just had another son, and I was going through the process of getting him insured tonight. I wanted to lock him in early. I want to own it as soon as we can. And now, you know, his future is secure. Something should happen to me, he's good. If he doesn't need it or use it, now that benefit passes on to his lineage. So we're trying to set this thing up to be generational. So I literally was on a call tonight before we came together as a group, trying to secure the bag, so to speak, for my second son.
Right on. That's awesome. Thank you.
And I basically have life insurance too, for my family to have money to put me away, and then I can leave money for my family and my son.
Right. Awesome. So that's something that I think that we share in common. Those of us who do have insurance, I feel like the primary reason a lot of us get it is because we definitely don't want to be a burden on something, because we don't know when we're gonna pass away, but we definitely gonna pass away at some point. And especially, I would say, as men, for sure, we definitely got to have our stuff together, because we don't want to leave our wife and our kids, you know, without stuff, right? But I want to pause there, because typically when we think about life insurance, we always fast forward to the death part, the benefit, right? But something happens before you die. A lot of life gets lived between then, right? A lot of life gets lived, right? And so typically when you have a typical insurance conversation, it's always death benefit focused. I want to take care of my family, right? But what about us, right? Don't they say when you put if you're on an airplane, I just got back, me and my wife just got back from a trip, and they say, hey, if the mask come down, put your mask on first, and then you put the other person's mask on, right? So I want to talk today a little bit more about life insurance, right? Actual life insurance, things that we can use while we're living, right? The cash component of life insurance, which is something that nobody's actually really taught. I feel like it's a secret, it's a mystery between even just in the insurance industry. You got kind of two sides of the equation. You got people who only do term insurance, but then you got people who only do whole life. And then you got some people who do a little bit of everything, you know? And so I kind of want to shift the focus to cash value life insurance today and show you how you can use it, how I actually use it, and how I coach and teach other people to use insurance. Okay, so I'm gonna start with the basics. And I don't know if we're gonna get a chance to get through everything today, but I'm gonna do my best. Hopefully I can come back. If I do good enough, I might be able to come back. All right.
Absolutely, Brett.
Definitely welcome to come back. I will say one thing real quick to jump in.
Yep.
Please make sure you get your notepads out and take notes. That's one of the biggest things we want to emphasize about this call. Make sure you take notes.
Right on. Okay. And I ask questions. Okay. I'm gonna ask a lot of questions. I'm gonna call on people. I can't really see everybody on the thing, but I'm gonna just call random people just to make sure everybody paying attention. All right. Cool. All right. So typically, when we're looking for life insurance, right, we kind of go shopping and we just say, all right, how much insurance do you want to buy, right? And you know, maybe you'll go online, you'll search some quotes and just kind of see how much the insurance costs, right? But I want to highlight something. I'm gonna say this over and over and over tonight. There's a difference in what you pay and how much something costs. There's a huge difference. All right. So when you are looking at an insurance policy, there's two things that you have to separate. The first thing is what you call your premium. Wait a minute. Your premium. All right. So what is your premium? Your premium, that's just what you pay. But the second thing you got to look at is your cost. And what is the cost of? It's the cost of the insurance, right? So what does that mean? It means that whenever you buy an insurance policy, you pay a certain price for the insurance, but the insurance actually costs a certain dollar amount for the insurance company to insure you. And so the cost of the insurance is going to be based on four things. The first thing is going to be based on our age. The second thing is going to be based on our health. The third thing is going to be based on our sex. And then the last thing is going to be based on is the death benefit. Now we're going to get advanced today. All right. Most people are familiar with death benefit, but it's also known as face amount. It's also known as the specified amount. Right. So if you're looking at your insurance policy, you kind of just see you don't see something that says death benefit, you see face amount or specified. It all basically means the same thing. Right. So if we look at how insurance companies actually price their products, right, at the end of the day, it's insurance. So let's just say you wanted to buy an insurance policy and it was a $500,000 death benefit of an insurance policy. Well, if we look at age, insurance companies have these things called actuarial timetables, right? And so they have a chart that goes all the way from age 0 all the way out to age 121. Right? Because because a person can be 0 years old. You got to be at least 15 days old to get an insurance policy. And you got to be 18 to own your own insurance policy. But this timetable goes all the way to age 121, and it's known as the cost of insurance curve. All right. So let's just say that you wanted to buy an insurance policy and you were 20 years old today, and you wanted that $500,000 insurance policy. Maybe it would cost you, let's say $20 a month for that $500,000 policy. All right. But let's say if you were 30 and you wanted that $500,000 policy, maybe it would cost you $30 a month. All right. What if you were like 45? Maybe it would cost you $100 a month for that same $500,000. But what if you were like 60 years old? All right. Then maybe we're talking like $300 a month for that same 100,000. Right. So who wants to share what they notice about this cost of insurance curve? What can we tell from this?
The older you get,
the older you get, the more it costs.
Yeah, the older you get, the more it costs. And why do you guys think that is?
More
Because of
health
challenges
challenges.
and closer to probably the
Close to transitioning.
Yep. There you go. That's exactly it. Because if I asked you guys a question, who's most likely to die? A healthy 30-year-old or a healthy 90-year-old? Who would be most likely, even if both people are in the best shape of their life? Just based on
90-year-old.
The healthy 90-year-old. Exactly, right?
Well, nowadays it's a toss-up nowadays.
True.
Right on. It is a toss-up. You never know.
I'm really serious.
Exactly. So there's two ways that you could actually attack this curve, right? Because the cost of insurance is just the cost of insurance. Typically, when people are buying insurance, they'll focus on term insurance. All right, term. All right, so that's the most popular form. The other kind is called permanent. All right, so when you guys hear term insurance, I want you to think rent. When you guys hear permanent insurance, I want you to think own. Okay, rent versus own. There's pros and cons to both. It all depends on where you're at. All right. Now, if we're looking at term insurance, typically these will be sold in different time or durations or periods, right? Like a term, a length of time. Typically, you'll see 10-year. You could also see 20-year. You'll also see 30-year, right? And then also, if you have work or insurance through work, that's called group term. And that's usually what people will have through work. Okay. So let's just say that, let me see, who do I want to use as a student today? Let's see. Who wants to be a volunteer? This is like school all over again, right?
I got you.
Awesome.
I took, oh,
I was about to say, let's not all speak at once. Okay. So who said I got you?
AJ.
AJ, I'm trying to scroll through. Okay, there we go. What's going on, AJ? Where you from, bro?
Originally from Tuskegee. Right now I live in Long Island, New York.
Right on, bro. Appreciate you for helping me out right now. So I got a quick question for you. All right. So let's just pretend for a minute that you are 20 years old today. Or are you 20 years old, or are you older than that?
I'm over. I'm 34.
Okay, right. Oh, we the same age then, bro. Cool. So let's just pretend we was as young as we used to be. We was like 20 years old, and we wanted to buy this insurance policy for $500,000, right? And you know, at 20 years old, we don't have a lot of responsibilities, but maybe we got people in our ear who's telling us it's a good idea to buy insurance because you want to lock it in while you're young, so you don't have to think about it anymore, right? But our pockets, our income, we don't make that much money, so we got to find the cheapest thing we can find.
Right.
Typically, that's going to be your 10-year term policy, right? And so what a 10-year term policy does is going to be a policy that's going to be good for the next 10 years. And so if you look at this time period or on this cost of insurance curve that I talked about, you'll see that at 20 years old, the insurance costs $20 a month, but you'll actually pay closer to $25 a month for 10 years. So why are you actually paying $25 when the insurance only costs $20? Well, if you think about how old you'll be 10 years later, how old you're going to be? 30. And how much would the insurance cost at 30?
$30 a month.
$30, right? So you're actually overpaying in the earlier years. You're paying $5 more than what the insurance actually costs in the early years, but then you're actually paying $5 less than what the insurance costs in the later years. So you're paying an average, somewhere right in the middle. Does that make sense?
Yeah. So like coming in early, you in essence do save a little bit. It kind of seems like you get like a $5 discount because it's like you came in.
Well, I wouldn't even say it's like a discount, because even though you pay $20 a month, technically the insurance costs $20 a month, right?
Right.
But you're paying $25, right? So you're actually paying more than what the insurance really costs up front, but then on the back end, you're paying less than what it costs.
Right.
Right.
But by the time when it switches over to $30 a month, you've already paid, the over.
Exactly.
With the extra $5.
Exactly. So what they don't tell you about insurance is even though that you're paying the same dollar amount every single month or for years, the insurance cost goes up every single year because it's based on this cost of insurance curve. It's called a mortality table, right?
Mm-hmm. And
so has anybody ever wondered how insurance companies make money? Why has an insurance company never gone out of business? Specifically a life insurance company.
They typically don't pay.
Yes, they typically don't. And I'm going to talk about why they don't pay a lot.
Mm-hmm. Yeah, because people are dying, right? Like, as far as I know, people been dying. So how they not paying out? Yeah, but so not to front run it. this was a conversation that I was having earlier, B. People, if you talked about this when we linked, right? You said, look, I've seen some policies and I'm like, yeah, that could have been done better. One of the things that happens, you have to be truthful. So you can pay for 20 years. They're going to investigate you. If what you said doesn't hold up, they owe you nothing. You violated a contract.
Yep.
So insurance is a contract. And for so many people, they forget that business piece of it. So yeah, you've paid your premiums on time, but you violated the terms of the contract. We don't owe you anything. And so you got to be really careful, guys, ladies and gentlemen, family, when you're going out to get a policy, being able to pay it is one thing, but making sure you're true to term or true to the terms. That's a whole different dynamic, because you can think that you've secured your family and you really could be putting them in a bad situation because they're relying on you, and that contract is going to be null and void. So you gotta really think about what B is asking you here. This cost is just like if you went and got a car. Would you pay for the gap coverage? You know, you're paying for gap coverage in the event that something happens, right? And that extra $5 is similar to the gap coverage. You're paying now. In addition to the principal, that's the interest. They're just saying we're taking ours off the top. We'll catch up with you on the back end. And if you're in good health, if you continue to pay, there's so many variables that have to happen for you to actually receive your payout. But I'm gonna get out your way. Let me get out of the way, Greg.
Oh no, that's good, man. That's actually good input. That helped me transition right into the next piece, because exactly just like you said, insurance is a contract. That means both parties agree to certain terms. So what
before
happens
you
if,
transition? I'm sorry. Before you transition, will you go back to your example with AJ and finish that one?
Yes.
Because you got okay. Thanks.
Yep, we got you. All right. So AJ had this 10-year term policy, right? He was paying $25 a month for 10 years. Now, after 10 years, what's likely going to happen is his premium is going to double, triple, or quadruple. Why do you think? Well, think about it. That's why I say I want you guys to think about term like rent. Has anybody ever rented a home or an apartment here before on the call? I think maybe we've all done that. Yes?
Yes. Yep.
Yep.
All right. Has the rent ever gone up on you?
Absolutely.
Yes.
No.
Yes.
Yep.
Did the rent go up while you were in?
Yesterday's price
is not today's
price. That's right.
So check it out. Did that rent go up on you while you were in your original lease agreement, the 1-year lease, or was it after?
After.
It's always after. So think about it from the insurance company's perspective. Exactly. If you sign 10 years, you agree to pay a specified amount for 10 years. On after 10 years and 1 day, that premium is going to skyrocket, right? Well, I guess it depends on the policy, but we just gonna say it's gonna be more than what it was. All right. So typically when people see that, they get that notice in the mail and they say, wait a minute, my premium's going up to $100 a month. I was only paying $25. That's because the insurance company wants you to renew. They want you to lock in another lease, right? And so typically what people will do is they will opt for the longest period of a term you can get. Typically that's 30 years. All right. So that means that AJ in this example will be paying the same premium for the next 30 years. So let's say AJ is paying, I don't know, from age 30 to age 60, let's call it $75 a month for 500,000. You know, AJ's not thinking much of it. You know, he's like, oh, $75 a month, 500,000. Shoot, that's cool. You know, actually, if we're looking at the real numbers, that's kind of that's a lot. I know we got some licensed agents on the call, so you know it is kind of no, this is all concept. It's just a concept, not actual numbers. All right. So what ends up happening at this point, AJ's paying us $75 a month for the next 30 years. Now all of a sudden, AJ is 60 years old. At this point in time, AJ, what would happen with your life insurance coverage?
Based on my limited knowledge of term, at some point my agent, if they were good, would have called me and I would have had, you know, maybe some conversion credits or conversion capabilities But ultimately, what I think happens to most people at this time is at the end, you've come to the end of your term. Both parties have fulfilled their agreement. The insurance company said, hey, if you died within this time, we pay you. You didn't die, so have a nice day. We got some more products we can offer you.
Mm-hmm. Exactly. That's exactly what happens, right? And I'm glad you mentioned out like a good agent should be reaching out to you, right? Because one of the things that kind of hurts people here as they get a little bit older, and let's say they had this term policy for their whole life, is not having the right policy, a policy that allows you to convert your term policy into a permanent policy without having to prove insurability. That's important. Why? Because the biggest factor in life insurance is health. Do people get healthier as they get older, or do they tend to develop some challenges? I know everybody's different, but odds.
Usually they develop challenges.
Develop some challenges, right? So let's assume that this person, AJ, I know you healthy, bro. You take good care of yourself, but let's just say you develop some challenges right around that age 60, and we didn't have a policy that guaranteed you the ability to convert. Okay. Well, then now you might have to pay a higher cost of insurance. It might not even be affordable at that point. It might not even make financial sense to do it at that point, right? And so we got to look at other options, right? And so that's why I want you guys to think critically about term insurance, because term insurance is renting, whereas permanent insurance is owning, right? On average, the insurance company is right 98% of the time, meaning people will outlive the term policy or they'll just stop paying for it somewhere along that time period. 98% of people outlive their term policy. So what happens with all those premiums that were collected for the past 40 years? Who keeps that? Does the
insurance company?
Yeah, and now we wonder why they got money. They balling. They got built actually trillions if we talking collectively, right? Because they got this down to a science. Okay. Now on the flip side of that, I want to talk about term and perm, not like perm your hair. Anyway, so AJ, you still with me?
Yep, I'm here.
All right, AJ. So let's go back to you being 20 years old again.
Mm-hmm.
All right. And instead of looking at a term insurance policy that's worth $500,000, now you're looking at a permanent insurance policy that's worth $500,000. And maybe the premium for this one is like $250 a month. All right. So if you on the outside looking in, not knowing anything, right? You see one policy that's $250 a month for $500,000, and you see another policy that's $25 a month for $500,000. Which one would you likely choose?
And I'm 20 years old, right?
Yeah, 20 years old. Yep.
Hey, like, yeah, you know.
This one all day, huh?
Look, we being honest, yeah, $25 a month.
Hey,
$25 a month at 20, because $250, that's you know,
cutting into your clubbing.
Hey, not even that. That's a car note on a you know, if you got yourself a good Honda Civic or something, paying the note on it. That's the car note and the insurance right there in Alabama, DJ. You know that.
There you go.
Hey man, I'm from right there with you.
Exactly. But, that's some people's rent too. So like that's a hefty bill down south. So yeah, we picking that 25 all day
long, right?
The crazy thing about it is, as Brandon is unpacking this, I'm reliving my 20s. And I'm thinking about the fact that I probably let like 3 policies lapse myself. They were super cheap. They were whole life. And I could have paid for them and been good, you know, and secured everything by the time I'd already met my wife. Like relearning things and having to I say this all the time, Brandon. I know you haven't been on these calls, but Vassar will tell you. I tell everybody. People be like, experience is the best teacher. I do not subscribe to that. It is the most expensive teacher.
It's expensive.
Man.
It is an experience. It is an expensive teacher, because as I'm looking at this, I'm like, man, I'm an idiot.
Kicking myself.
Man.
Brandon, bro, you would have to make an appointment with my assistant to even talk to me today. If I had done what I was supposed to do back in 20 years old, bro. Crazy.
This is the power. This is the power right here, because
yes, sir.
Brandon, we teach compounding interest, right? And so we talk about not doing you don't have to hit a home run. You just need to be consistent. This is James's thing, right? So not doing one thing great one time, but doing the small things great over time, right? This is a prime example of just getting it right and getting out of the way.
Yep.
So
Right
so please take us home.
Okay.
Explain to us why that 250 right there is not life changing in terms of what is going to hit your pockets for, but what it's going to do for generations.
Exactly. Let's talk about that. See, this is why it always go back to there's a difference between what you pay and how much the insurance costs. So most people, they shop on price. They just want to know how much is it and how much do I get, right? But what are we buying, you guys? We buying money. Is this money any different than that money? It's $500,000.
But that's heavy, B. Unpack that. We
Unpack
buying money.
We buying money. Well, let's think about it. If you have an insurance contract for a certain death benefit, you're paying a premium, right? You're paying to buy future money, contractual, guaranteed money. It's no different than buying a house that's $500,000. If you don't have $500,000 to buy a house, then what you got to buy first? A mortgage. Notice I didn't say get a loan. You're buying a mortgage. You're buying money. They're charging you interest to be able to pay for that house. The house is paid for in cash, even if you get a mortgage on it. We're the creditor in that situation. We actually, we don't go down that. I don't want to confuse it.
Oh, no. We've been there. You can do it. You can do it. They ready. They ready. They ready.
So check it out.
Dropping all the sauce up here.
When we buy the house, when you close on it, the bank that made their money, Wall Street is now making their money because you agreed to pay back that debt over 30 years, right? Those are things called mortgage-backed securities, where they're just trading paper off the debt that we incur, right? So we create credit for the banks. We create credit for Wall Street by just signing our name on that piece of paper. So the bank is out the way, and despite what they say, the bank is out the way. They're not liable for it. They good, right? They sell that paper to Wall Street, and then Wall Street sells it to the pension funds. You feel me? And the pension funds, that's how they make money to be able to support people's pensions, because people are paying their mortgages, right? This thing gets deep. It's like a rabbit hole. You don't, once you go down it, you just gonna be, you're gonna be in it.
Hey man, it's session one, man. It's all good.
You're gonna be in it. All right.
It's
so
like the Matrix.
For real though. So check it out. We buying 500,000. AJ's 20 years old. He instead of buying the term policy for 25, let's just say he buys the permanent one for 250. Okay. Well, just because he's paying 250 doesn't mean the insurance costs 250. AJ, at 20 years old, how much does the insurance cost?
The 250, right? That's what we're talking about.
I said at 20 years old, how much does the insurance cost?
$20.
Who said that? 20? AJ?
That's Courtney.
Courtney, you absolutely right.
I phoned a friend on that one. Yeah.
Okay, got you. Right on. You absolutely right.
Courtney used to sell insurance too. BA.
Right on, man. Yeah. That's what's up. So remember, that's our premium. Once AJ pays that, the cost of his insurance is $20. So we got some money left over from that payment, about $230. But what happens with that $230? Well, that's going to go over here into a savings account. We got any homeowners on the call?
Yep.
Bam. We got equity in our homes. We create equity in our home when we make that mortgage payment, right? This money that goes into this savings account inside of the insurance policy will actually compound. And it will compound tax-free. And it will compound tax-free with zero market risk. Right? So it's a pretty safe, pretty predictable, pretty reliable way to save your money. Way to save your money, right? Now, this is a key point. You might want to write this down. The key reason why this savings account actually exists was not for savings and equity. Well, actually, it was for savings, but it was actually savings to help supplement the cost of our insurance as we get older. All right. So what happens is if AJ is paying this $250 a month for the next, let's call it 30 years, he's going to build up enough compound interest, extra cash in this account to pay for his costs, even though his cost is going up on the back end. Right. So despite whatever policy it is, whether it's term or permanent, the cost of insurance always goes up because it's based on your age. Right. The way that you help supplement that cost is by saving, right? Growing the cash inside of the permanent policy, just like you would in any other account. And then that supplements the cost as we get older. All right. Now, this is where it comes down to structuring a policy the right way. If you're doing permanent, you want to have a policy where you're not paying the minimum, right? This is a very important piece. Let me go. All right, so we got our premium, right? That we talked about. And let's say that premium was $250. Okay. All right, then we have our death benefit. And let's say the death benefit is what we said it was, $500K. Let's put DB. All right, so when you buy this insurance policy, there's a minimum and a maximum of what you can pay for that $500K. Okay. Need to move that out of the way. All right, so the minimum premium for this $500,000 policy, maybe that is $250. I'm gonna use $250 for this example. Okay. All right. And so who determines what the minimum premium is? That's the insurance company, because they just need to get enough money to cover the death benefit, right? But then there's also a maximum premium. And let's say that maximum premium is, let's say $5,000. Anybody want to guess who determines the maximum premium? If the insurance company determines the minimum premium, who would be determining the maximum? It's got something to do with taxes.
Feds.
The government.
There you go.
Feds. IRS.
Uncle Sam got his hand in the bag.
IRS.
The government.
Let me ask y'all a question. Why in the hell does excuse my language, why in the hell does the IRS care about how much money somebody will put inside of a life insurance policy?
Oh, because that's called tax deferred money, ain't it?
They're tax free, tax deferred.
Yep. Money out tax free.
That's called laundering.
Yep. Hey, so check it out. There's actually and so when we design policies for clients, we got to educate them back on like the tax laws that came out in the early 80s. There was 3 pieces of tax legislation that were passed to stop exactly what I heard somebody say, money laundering on here. Somebody said money laundering. So, like with a 401k, there's a maximum you can put in per year. With a Roth IRA, there's a maximum that you can put in per year. All right. Life insurance, there was no maximum prior to 1982. All right. People used to launder money inside of insurance for those same reasons I just told you. Number one, it's safe, it's predictable, it's tax-free. And it returns way more than what a bank CD would. All right. So if you got a lot of money and it's just sitting, people used to just sit their cash inside of insurance, actually just call them insurance contracts, because really it's just an account at the end of the day. And that's what they used to do. Mitigate their tax risk by doing those sorts of things. Okay, now I'm gonna pause there. Do we have any questions? No questions?
No questions.
Okay, cool.
Good stuff.
All right. Now I appreciate y'all for being patient, because this is the boring stuff. This is the basics. And this is, I drag everybody through this, because if we get to the end, we just put it this way. We can't put the cart before the horse. Because if we get all the way to the end, which we might not even get to the end today, that's why I say y'all have me come back on. But I'm gonna show y'all the bigger picture. The bigger picture is what I'm talking about today. But if you don't understand all this stuff, the bigger picture don't even really matter, because then you're gonna have all the questions like, okay, well, how's this working? And all that stuff. All right, cool. So there are 3 different types of insurance policies that are permanent. Okay. Most people have heard of this one, whole life. All right, whole life is great. Whole life is actually I call it the OG. It's like the iPhone 1 of insurance. It's got the most tenure, right? People still use it, right? But there are some different products that could give you a little bit more flexibility. But from a whole life perspective, you're talking about a fixed rate of return. Fixed. Typically, you're going to get the rules just change 2%. Some companies are doing up to 4%, and that's guaranteed. Okay. All right. Now, I don't know any place today where you can go get 2 to 4% guaranteed return on your money. Does anybody know of any on the call today? Tax-free. Let me disclose tax-free. Anybody care to share? Nope. Can't think of it. All right. Y'all let me know if y'all find one, because I'm always looking for things to do, places to store money, like for real. All right. So the whole life, those are the biggest benefits. You got a fixed interest rate. You're getting 2 to 4%. You could get some dividends. You're talking guaranteed and tax-free growth. All right. But what I would say, this is more geared toward actually not being flexible, right? This thing is rigid. So if you're a person where you're like, okay, I just want to pay the same premium, and I just want to guarantee a death benefit or guarantee a certain return on my money, then this is the way to go. All right, because you're talking a guaranteed rate of return. Okay. Now, this is the biggest downside, is that it is rigid. D said earlier, Destrin, you still there? Nope, you still.
Sure, I'm right with you, bro.
You there? You said earlier, you said you had some whole life policies back when you was in your 20s.
I should have paid for them.
Should have paid for them.
I should have paid for them. I could have took the cash value, paid the policy off, bought a new policy with better riders, and been in a much better situation. But I didn't think about it in the context in which you teach it, right? So I didn't understand the facets of it. I just looked at it like I'm throwing away money.
Yep. Yeah.
Like, I'm gonna live forever, right? So I'm 20. What am I gonna do? But in hindsight, should have paid it off. Took the cash value that was appreciating. Had I stayed the course, I could have been up a few $100,000, take 30, 40 grand, purchase a whole nother policy, pay for it outright, allow the cash value to accumulate there, and then pay myself and cover the spread on everything else that I was doing. Like James said, you had to talk to somebody to talk to me. You know what I'm saying?
Yeah, right on, man.
I fumble.
Hey, it's all good, man. And that's one of the things that I'm glad you shared that. This right here, rigid. It's not as flexible. If you miss a premium, then we at risk of letting a policy lapse. If like you miss like 1 or 2 premiums and there's not sufficient cash value in it, then you could lose the whole policy. That's why it's guaranteed. In order for the insurance company to guarantee you 2 to 4%, then you need to guarantee a certain premium is going to go in there every month, because they're basing all of their numbers off of what they tell you off of what you tell them, if that makes sense. Right? So contract, 2-party agreement, it's got to work both ways. Now, whole life is great. But then back in the early 70s, there was another type of policy that came out, and this one was called variable. Variable universal life. All right, and so in a they call them VULs for short. So VUL, and I know my V and my U look exactly the same, but it's a variable universal life. And the good thing about VUL is that there is no limit on the interest that you can get credited, right? Meaning because the way these works is they'll actually purchase things like mutual funds. You guys know what mutual funds are? Anybody ever heard of mutual funds?
Yes.
Yep. So you can actually have mutual funds in a sub account of a life insurance contract. So whatever the mutual fund does, you get. 1 second. Sorry. Little girl just popped in the room. I don't know where her mama is.
Oh no, we don't apologize
Yeah,
for that around
we
here.
I'm about
This
to
is-
say that's
we do
family.
not apologize for being parents around here. Trust me. This is a ongoing theme for Global Vex Trade Club. We actually we enjoy seeing
the children
men-
of the children of GFXTC.
right. We enjoy seeing the parents in effect. But family,
Here we go.
B is back. But I was gonna bring you guys up to speed real quick on a couple of things that he's talked about, and I know we have to focus in on. I want you to understand what he's saying. He's not saying that whole life is bad. He's not saying that any of these things are bad, but what does your situation call for? What is the outcome that you want? 2 to 4% guaranteed, most people will take that. Still tax-free, but that word that he underlined there is rigid. You can't change that. You set it, you forget it, you go. It's in the mutual fund world, we call that long only. You buy and hold. That is it. So what he's talking to you about is a way that you can get a little bit more sexy, right? You can dress this thing up a little bit. You can customize it for your life. So again, if you're not taking notes, this would be a great time to really plug in. So go ahead, B.
Right on, man. I appreciate that for filling in that gap. And just so you guys know, this is just the basics. We haven't gotten into the concept because you guys had mentioned we want to talk about application. How do you apply this? And I'm gonna share what I do, how I apply it with my lifestyle. But you got to understand these 3 pieces in order to understand the next part, right? So typically in a VUL, you can purchase, mutual funds inside of that account. So the benefit of that is there's no limit on your growth. So think about how smart these guys were when they came out with this. They said, we got this whole life insurance product that we could get. And the whole life used to return more than the 2 to 4. It was closer to like 6 to 8. So you're talking about 6 to 8, no market risk, tax-free. That was insane. But when that, when that happened, there was also a big bull market. Do you guys know what bull markets are? I feel like I'm talking to it. Okay.
Yeah.
I feel like I can use this language. Okay. So early 80s, boom, we've been in really a bull market since the early 80s. A lot more retail investors. And so why settle for 6 to 8% when you can get in a mutual fund or some along those lines and get 15, 20 a year, because that's what the market was doing. And so somebody smart enough said, wait a minute, what if we create this account and just put mutual funds in the account, and then under the tax code, because life insurance is nothing but a tax code, we can file it as a life insurance account. We can draw up the contract to make this a life insurance policy and not an investment, because investments are taxed as investments. Life insurance is not taxed because it's not an investment, although we're getting real technical because technically this is a security, but it's still not an investment, even though it is a security. God, this can get complicated. All right, so that's the good thing. Unlimited growth. But then what's the bad thing about that? What goes up can also come down. So where this could hurt you a little bit is, you remember that cost of insurance curve that I talked about?
Yep.
What happens when we get way up here? That
More
cost
cost.
goes up, right?
Right.
Mm-hmm. Who remembers what the primary purpose is of that cash in the savings account? What is it supposed to supplement as we get older?
Payments.
Supplements the cost of the insurance.
The cost of the insurance.
Yeah, exactly. So let's say I have 500 grand of cash here, and I was like 65, 70 years, let's just say 60 years old. And I'm using that to help offset my cost of insurance. And I'm still using this money, taking income from it for retirement, right? But then let's say a 2008 like market correction happens. And let's say we lose 40% of that. How much would that be? We'd be down to like what,
300,000. Yep.
Right. So I got my cash going down and my costs going up. So what could happen is I could actually lose my policy. I might have to put more money in order to be able to make sure that this policy doesn't expire. All right. Because it took us a while to be able to pull that number back up. Well, it's been up a lot since then. But that's just something to think about. Also, I want to highlight the flexibility that VULs have. whereas whole life is a lot more rigid. Variable universal life is a lot more flexible. You can pay every other month. You can pay every month. You can pay 3 times a month. You can pay once a year, twice a year, or you can just pay it whenever you pay it. Just think about it like your 401k. You just pay it whenever. You just contribute. You know what I'm saying? So that's how that works. Now
Hey,
the
B,
last one. Yep.
Can I ask you a question here?
Yes.
So when you say pay or contribute, help me understand in layman's terms, help me understand. Am I contractually obligated to contribute on some type of basis?
Mm-hmm.
What flexibility in that contract gives me the optionality to have that bandwidth, so to speak?
Got you.
Can you talk a little bit about that?
Yes,
I really want them to hear it.
Okay. So it comes down to, hold on, wait, how do I go back? I wish I would have saved that other thing that I had here. Okay. So you guys remember that premium that I talked about?
Yes, sir. The cost.
Mm-hmm. All right. Remember, there is a minimum,
Mm-hmm.
and then there's a maximum.
Mm-hmm.
So let's say I have a policy and the minimum is $100 a month.
Yes, sir.
Okay. But my maximum is $1,000 a month. Keep in mind that minimum cost is for the death benefit.
Yes.
So if you want only the death benefit and your goal is to not grow your cash in here, then you're going to pay the minimum, right?
You come hang out right here with me.
Right
there. You get what you get and don't throw a fit.
Now, right up top, right? We can fund it any way we want to, right? We can fund it up to a maximum of 1,000. So typically when people get a UL, a lot of times it's misrepresented by whoever is helping them get the product or setting up the product, and they just kind of just set it. Let's say, for example, let's say a client said, hey, I want a $250,000 insurance policy. A lot of times I see the agent that'll just find out how much they have to pay for the $250, but they're not taking into account.
They're basically paying the minimum. They're just getting the death benefit.
Correct. They're just paying the minimum, getting the death benefit. Variable universal life and index universal life, which I want to talk about next. You want to overpay it.
And guys, what he's saying is overfunded. Okay.
Overfunded.
So you've heard us use that terminology before. Overfunded. What's the reason why they want to overfund it, B?
You want to overfund it, right? So let's say that I can get, in a lot of these policies, you can get 10% growth easy. I got
how much? How much?
10% easy.
How much were we getting? How much were we getting on our whole life? 2 to what?
2 to 4.
Now, fam, if we following our trading plan, we get our 1 to 3%. That's cool. This is not your trading plan. Mm-hmm. If he's going to be able to show you a way that you can maximize your growth potential and reduce your risk at the same time, mm-hmm. Would you be interested in that? Drop some ones in the chat if you'd be interested in understanding how you maximize your growth and reduce your risk in terms of just passive investing in what you're already doing. Just some ones. And the reason why I'm asking for your participation is because I need you to understand what he's unlocking right now. It was important to kind of go through the sequential nature and the order of things so you had the basis to understand what he's about to tell you. Because for me, I got a few degrees on my wall that I could, pound my chest on. I still didn't understand this concept. And frankly, what's crazy is as Brandon continues to become a part of this community and Anthony continues to become a part of this community, this is not something he's done for a lifetime. This is something that he spent his 10,000 hours on to become a subject matter expert. They've put in the work and the time. When he and I talked, I was like, yeah, man, so you finance. Nah, bro. Yeah. Nah, not me. Hey, he's like, I stumbled upon this.
Hey, I appreciate that, bro. I remember hearing that you work on something for 10,000 hours, you become an expert on it, Yeah. And I'm just like, wait a minute, I read that. And I've been living that like years ago, bro. So I appreciate you for bringing that revelation to me right now, man.
Yeah.
That's a big affirmation right there.
But again, I'm gonna get out of the way. But they dropped the one, so
are we gonna get there? We're gonna talk about the leverage.
Man, listen,
that's really what this is.
We in here. Don't worry about the time. Like you say you go as long as your wife will let you go.
Yeah. Okay.
Until she pull me out of this place. So
all right.
Give it to the people, man.
Got it for sure. All right. So real quick, minimum. If you buy an insurance, permanent insurance, you do not want to fund it at the minimum. You want to overfund it. You want to fund it as close to the maximum as you can. Right. So if I fund, keep in mind. So let's just do it. If I pay $1,000, if I fund it at the max, and my cost comes out of $100, that means I got $900 in there, right? If I make 10% on that, then that's a $90 profit. That's tax-free. Now I'm at $990. Okay. All right. So now I'm at that $990. What happens is the following year, let's say I get another 10% on that. That's your compounding interest. So now you're supplementing the cost of your insurance, the fees, off the compound interest and the growth. That's why you don't want to minimum fund it, because you don't have enough excess cash going in there. And matter of fact, let's talk about this now. We got any options people on the call who do options or know about options trading?
Where Vassar at? Vassar does.
Yeah,
I knew he was good.
Yes, sir.
All right. Man, can you tell us what a call option is? Can you tell us, expound on that a little bit?
A call option is a contract to buy, to own the security, own the underlying security at a certain time in the future.
Mm-hmm.
And so if you're buying the call option, you're long, meaning you're hoping that I could acquire this, and at some point it goes up in value, and I earn that profit.
Mm-hmm. Yep. It's kind of funny, right? Call option, it's a contract. It's literally insurance in the market. You're buying insurance because you're buying the right to purchase a particular security at whatever the price is today, in exchange for buying it you want to buy it at today's price yesterday. Because yesterday's price is not today's price. You want to buy it at today's price yesterday, and then you sell it for yesterday's price. Now you just made some money in that scenario. Did y'all follow that? Did that make sense?
Yes, sir.
Yes, sir.
Yes, it
Okay,
did.
cool.
Yes, sir.
Right. So the way Index Universal Life works is this. It came out in like 1996 or 96. And essentially what it did was it took the guarantees of a whole life product, and then it gives you the upside potential of whatever of the stock market, right? So your money is not actually invested in the stock market. They are just mirroring what the stock market does, and they're going to credit you doing that. And how they get the money for the credit is that they actually buying call options. So the market goes up, that's good for us. We get to earn up to the cap rate of that index for that particular year. If the market goes down, they just don't exercise the option, but we still keep our principal, what we started with. So that's powerful. It's extremely powerful. And when I say I got 10%, I got 10% over the past couple of years. I've been using Index Universal Life as my savings account. I still make other investments and do things that can yield a lot higher of a return, because you can laugh at 10% these days, especially when you got crypto and like all the other stuff out there, like what Forex, everything like that. But this is the savings account, not the investment account. And there's a difference. Okay. So IUL works like this. Let's say you got your money right there. And typically they'll track an index like the S&P 500. But there's like different ones, right? And typically they'll track it up to a cap of 10%. But then on the flip side of that, they will guarantee you 0%. That's your floor. All right. And so these work on an annual point to point, meaning from February 2022 to February 2023, they are tracking where the S&P 500 index is, the value of it, right? So let's say you put your money in and the market did 10% during that time period, then they're crediting you 10%. If the market did 5% during the next crediting period, then they're crediting your account 5%. Well, let's say the following crediting period, the S&P 500 returns something like 30%. Then because you have a cap of 10, you get 10%. But if the market goes negative, let's say 30%, then you get what? What do we get, you guys, you think?
0%.
Right? Importantly, you get to keep your gains. You get to keep that, and you keep that. That is huge. How many of us have ever been on like we got some traders on the call, right?
Oh, no doubt.
No doubt, right? That's what I'm saying. So we ever had like some good days back to back to back, and then just had a terrible day, like a negative 30 day?
Right. Just wipe out
the market.
Wipe out the whole.
Wipe out all your gains.
I'm looking at my account right now.
It's gone.
Man,
It's gone, right?
so Clark, you telling me that you're gonna force me now, like, because you don't love me. You're gonna force me to participate in the power of compound interest and get out of my own way. I get the lock-ins. Worst case scenario, I just don't get a game.
Mm-hmm.
I hope you guys are listening. I hope y'all listening.
That's it.
Because this is important.
Yeah.
You can't even get in your own way with this.
You can't, especially when I show you guys how you fund this.
Let's do it.
You fund this.
That's the part that excites me. I'm like, oh, get to the end, but it's important to go through the steps.
Right.
At the end, what you don't want to have is, what was term again? No, we've already done that. We've already gone through all that. So now this is the progression.
Exactly. This is progression. Literally. And I do it this way because what I'm about to show you guys can only be done with Index Universal Life. My firm, Thrive Wealth Solutions, I'm not the architect behind this. My CEO, Rich Dawson, he's got 25 years in the business. Brother out of Detroit, moved out to Santa Clara, went to law school, found out he didn't want to do law, and been working in finance ever since he was like 22, 23. He's like 47 now. Him, along with a former semiconductor engineer. He was hey, Ant, where did Tony used to work?
What was it, Dell?
I wasn't Dell. It was one like, I can't remember what kind. Was it like? It ain't even where he worked, where he used to work. All it is, he's an engineer by trade and a financial advisor, and he basically used to do this on his own policies. What I'm going to share with you, but it used to be, but you had to wait like 10 years to be able to do this with a policy. Like you couldn't access money inside of your policy until you had sufficient cash value in it. This product, the way it's designed, was not even available until 2018. All right,
bro, it's a true game changer because my son was born in 18, and when I looked at what was available then, it had changed a lot. My first son was born in 18, and this is a conversation that we've had. Man, listen, when James and I talk, we talk money, and I'm like, hey, bro, what are you doing? Because I'm not the smartest person in the room, and nor do I want to be. I see you got your hand up, Lot. We're going to come to you right after this. Not being the smartest person in the room, trying to learn from those that have gone before us. We're talking, and, we talked about the HELOCs and things of that nature. But other people have been doing these types of things for a long time. Other communities have. And so I don't want you guys to think that this is something that is fly by night, is not vetted, is not tried and true. No, this works. People are generating significant wealth with these strategies. You just need to figure out how you can play in this space responsibly, right? You don't have to. Your goal doesn't have to be everybody else's. You just need to be able to play in this space responsibly. But I know Brandon needs to move on. But Lot, I see you got your hand up. Why don't you come off mute and address the group?
Hello, how you doing, Brandon? Just something real quick.
Yes.
I know that the term and the whole life, they have some restrictions as far as let me put it this way. I'm a senior, and they have some restrictions as far as age and health and all that other stuff. But now you're talking about the variable universal life and the index universal life. My question is, are there any setbacks for being a senior that you can't get it, that you wouldn't be able to utilize this or get into this type of insurance?
So you can get it. So the variable in the index is it's like whole life, but it just has a different investment component. So it's a permanent form of insurance. So
there's still some restrictions. I mean, not restrictions, but some kind of restrictions where if you're a senior, you have to be in perfect health and all this other stuff.
Well, you don't always have to be in perfect health. It kind of really just depends. It's on a case by case basis, right? So I know typically as like diabetes is a big one that kind of comes up like as people get like older, right? You can get a policy like this even with diabetes, and sometimes you can get it without a rating. And what a rating, I can talk about that. But basically insurance companies rate you based on health. You have like average health, then you have like above average health, and then you got below average health. Average and above is what they call standard. Anything below the average, then you fall into these different rating classes, right? And so that's called like just a lower, doesn't mean you can't get it, you just pay a higher cost. But the good news is that doesn't affect you from how you are looking to use this policy. If you are looking to use it.
That's the question, yeah.
Yeah, it kind of really depends. If you're looking for death benefit and you want to get the most death benefit, that's a different conversation. If you're trying to grow your cash, then the goal is buying the least death benefit. So the cost really isn't going to affect you because the IRS has these guidelines that we have to go by and whenever we set up a policy. So for example, let's say you got a 35-year-old, let's just say female, and she wanted like $1 million of insurance. Actually, she didn't want $1 million of insurance. Let's say she had 100 grand in cash and she was trying to do something with it. All right. Her minimum death benefit for that $100,000 insurance policy might be something like 1.5 million. So she has to get at least that much. And this is just concept, you guys. But then let's say if we took a 65-year-old female with the same 100,000 and she was trying to do this for max cash, then her minimum death benefit wouldn't be 1.5. It'd probably be closer to like 500. Okay. And that's like the minimum death benefit in that scenario. So it's just a little bit different. The younger person has to get more insurance. So there's a higher cost there because they have more insurance. Whereas an older person is getting less insurance, but they both cost the same because it's based on the ratio. The IRS has calculations for it.
Okay, I don't want to stop you from what you were doing before, but I'd like to talk to you further about some stuff.
Okay. All right. Yeah.
I'll get your information. Thank you.
Happy to help you. Happy to help.
Okay.
All right. Now let's erase this.
Okay, you were talking about the index.
Okay. All right. Yeah. I was like, what was I talking about? Okay. Yeah. So we talking about the index universal life. And I want to share with you guys like how I use this account. Okay. Now in any financial planning conversation, and you don't need like a financial advisor or, even really be all that smart to know this. Everybody has income. Right? And then everybody has expenses. And then what we don't spend, we save. Is that how everybody's money works? That's how mine works. Or you
that's the way it's
your money work like
that.
Come on. Come on.
Yeah.
Let's talk to Brandon, man.
It's supposed to work like that, but yeah, somewhat.
Okay. Yeah, got you. Mine actually don't work like this.
If we just swipe in Amex and Visa and Master, let us know that too, so we can account for that real quick. But this is how it works. Like this is your balance sheet. So get your balance sheets ready, and Brandon's gonna walk you through how you improve that balance sheet. Y'all ready? We ready? Nobody's talking to us. Y'all ready?
Come on, man.
Yeah.
Let's go. If you're ready, put a 777 in the
do it,
chat.
because y'all about to say,
Bring it, Brandon.
This ain't even gonna sound real once I tell you.
Nah, it ain't.
Happen. But then I'm gonna walk back and I'm gonna show you. like how this all works on the back end, but this is the part that got me when I understood this. Okay.
Hold on, Brand. We cannot proceed until I get at least 4777s in the chat. Let's go, family. Are you ready? Let's go. 777 me.
Right on.
Brandon, let's go.
Okay, we ready? All right, cool. So basic finance 101. You make money, you spend money. What you don't spend, you save, even though that's how it usually goes. Technically, you should save first, but we just start from the bottom, right? Okay, so you got your money. So let's say you make, as a household, let's say you make 100 grand a year collectively. And let's say out of that 100 grand, you have a bunch of expenses. You got taxes, you got your car insurance, you got your mortgage, you got rent, you got car payments, you got groceries, you got vacations, you got a bunch of stuff that you pay for, right? Let's say that totals at about $90,000 a year. All right. And so what ends up happening is you have this leftover amount that we call discretionary income. And that's typically what you save. And so how much would you say this family could actually save if they had 100 grand and they spent 90? How much could they save?
10,000.
They should say 10,000, but I say 5.
Yeah, exactly. On paper, they can save 10,000. Right. Yep. On paper, they can save 10,000, but man, I've been doing this long enough. If there's that much gap, we probably closer to 5.
Yeah. Yeah.
You never know, something might happen, because I'm looking at it from the perspective of, okay, if there is 10,000, then ideally they want to save that 10,000. 5 of it needs to go into some long-term investments, things that they should not even be touching. You know what I'm saying? Like where you just, who said it earlier? Buy and hold. Somebody said that. That should just be on autopilot, doing that way, right? Now this other money should go in savings, right? I kind of got off topic, but I think that was still good. Okay. But anyway, let's say these people are saving the full 10. And let's say they invest it and get a pretty reasonable rate of return of about 10% on it. All right. Well, after 1 year, that would be $1,000 return on their money, right? Okay. But because they spent 90,000, how much was their return on that? 0%. What if there was a way that you can implement a system to, instead of getting 0% on your expenses, you average about 3% on your expenses? What's 3% of 90 grand?
27. Enough to interest me in that.
Really. I went,
700, right? So conventional financial planning says, hey, in order to be able to get our financial goal, because that's why we all work and that's why we all saving money and investing and learning all these skills, because we need enough money to not work anymore. The only way you can do that is save up enough money to do so. So effectively, in the traditional way is, all right, this person would definitely need to save more. So how do we do that? We either got to increase their income so they can increase their savings, or we got to decrease their expenses so that they can increase their savings, right? Because most people focus on what's left over instead of focusing on the whole amount. We can use insurance to show us how to get a return back on the money that we already spent. Y'all want to see how that works?
oh yeah. Oh,
Yes, sir.
Yes.
Let's go.
All right.
Wow.
Show me the money.
Now,
This is where you call your friend that.
Yeah, you might want to get them on.
This is where you call your friend that didn't get on early.
okay, there we go. Yeah, this is it. Like when I saw this, I had no idea. I had worked in the insurance space for about 3.5 years before I even learned this. I didn't even know what insurance companies invested in at all.
Well, Brandon, before you even tell them that, I mean, you obviously have an economics degree. You obviously have a finance degree. You've been doing this your whole life, and this is how you became an expert at this. So please tell the good people about your financial background and the fact that you've been an expert your whole life at doing this, so that they can know that, if they want to do this too, they can just follow your path.
Yep, you can do that. Yep. I went to all the schools, got all the degrees and all that good stuff. Nah, y'all, I didn't do none of that stuff. You know, I'm from a super small town, Newberry, South Carolina, you know, raised by a single parent, my grandmother specifically. You know, I played sports. I mean, I got good grades. I mean, I didn't get the best grades, you know, but I got good grades. Like, you know, I feel like most of us are common sense is just common. Some of us just smart enough to just know, you know, stuff, right? But anyway, when I got out of high school, I moved to California to live with my mom, played football, ended up getting a football scholarship to Pittsburgh State University out in Pittsburgh, Kansas, not Pennsylvania. And from there, I majored in criminal justice, moved back to California. I did nothing with my degree. I'm one of those people that got the student loan debt and did not use the degree at all. So I kind of just wasted that. But anyway, from about age 22 to about age 28, I just worked job after job. I had no career. You know, I didn't even really understand what I wanted to do with my life. I just knew that I needed to make some more money because I don't know if y'all ever been to the Bay Area or California.
Yeah. You know, my wife from out there, bro.
Oh yeah, right over in Fairfield. Was it Fairfield?
Yeah,
right?
Yeah, for sure.
Yeah, it's crazy out here. But anyway, I started.
Why we ain't moving?
Yeah, right. Yeah. So I started just kind of looking for different options. I thought about going back to school. At this time, I was working for AT&T, and I had just got like a manager position, assistant manager position there, working on the retail side, which I hated. Did not want to do retail at all. If you do retail, you know, y'all the truth for real. Retail is hard work. But we got to do what we got to do at the end of the day. So make a long story short, I was working at my job at AT&T, had all my nice benefits. And I joke about this all the time because I remember this was my first, like I call it adult job where you got the benefits with the match, you know, you got discounts on stuff, everybody hitting you up, hey, can you plug me on the cell phone, this and that, you know, like that's that job, you know. But what ended up happening was I remember signing up for my 401k. I didn't even know, I knew what it was, but it just seemed so complicated. I just kind of shied away from it. I just put my 6% in. I think that's what they was matching.
Yeah. Whatever you're gonna match me, I can't leave that on the table.
Yeah, I couldn't leave it on the table. So I'm taking my 6% match. Fast forward about 18 months, and I'm considering leaving my company because I just wasn't making enough money, and I needed to have more time or money. I couldn't just do both. I was working long hours and just kind of struggling. And this is Motivation Monday, huh? So, all right. So I ain't mean to give y'all my whole life story, but
no, it's all good, man. We here for it.
Okay. So what ended up happening after that, my coworker's friend had pulled up to our store one day and he was driving a nice car. I'm talking Tesla before everybody had Tesla.
Yeah, his joint was backing up.
Mm-hmm. Yep. And I said, bro, like, what do you do for work? Like, it was just point blank and simple. And if I didn't work with his cousin, I probably wouldn't believe them. But he was like, yeah, I remember when he took the test to get licensed. I took the test with him. I failed, and I just started working here. And his cousin got licensed and started selling insurance and had a Tesla 2 years later. And so his friend, his name is Vic. Vic told me that he sold insurance for a company that was called American Income Life. So that was where I started my career. Small insurance company. They do a lot of like union work, with, like unions and things like that. But that was the grind. It was like, you know, calling leads and knocking on doors, and I'm just not that person.
Yeah, just cold calling. The cold calling it's a cold world in that.
Yeah.
The reason why I asked, because, you know, obviously, you know, we spoke and I knew that, but I wanted the group to know you're sitting here today unpacking a very complicated life issue, but this is not necessarily the lane and area that you've driven down for the vast majority of your life.
Right.
But you've spent the time though. You dedicated yourself to this profession, and you look up now, 5 years ago, what you would have been doing and what you are doing is different.
Right on.
And I want the group to understand it pays off.
It does.
You know, this is compound interest in action. You know, what Brandon and Anthony have been able to do along with their business partners, is compound interest in action. And so what he's about to share with you, I don't want you to think that this is some academic that's just coming to you talking about something that they put in a test case. This is real. This is real life.
Oh yeah.
You know what I'm saying? So, man, go for it, bro. I mean,
it's real.
I really appreciate everybody hanging in there.
Hey, right on,
man.
Hey,
man,
compound
listen.
interest ain't just about money.
No.
Everything compounds. Everything. And so, like, if you're working to get better every day, it's gonna show up. That's why they talk about a man is his habits. The man with good habits, he's gonna reap success. The man with bad habits, he's gonna reap poverty. You know what I'm saying? And struggle. And so I'm no different. I used to be in the struggle and be broke like all the time. I'm talking like negatives in my bank account. Y'all feel me on that? You know, and that's why I had to say, like, man, I had to change. I had to change the way I thought first. It was, and that's what I feel like the insurance industry was for. I feel like that was just my path of what God needed to do in order to shape me and get my mind thinking right, to get my mind thinking that there's just blessings out here for me. You know what I mean? So this industry has not just changed my family's life, but it's changed my life spiritually, emotionally, you know, financially, everything, you know, and I'm just happy to be able to give back and share what I can share. You feel me? So, all right, so let's go ahead and hop into the good part about this account. This is the mystery surrounding cash value life insurance, because it is a mystery, literally. Okay. So you guys remember the insurance policy I talked about, the IUL? Y'all remember that? Thumbs up. Yep.
Yes.
Okay.
Yep.
Yes.
All right. So I treat that like a savings account. This is my savings account. And on average, it pays 7% interest. Okay. And that's tax-free. So what would this look like if I put $10,000 here inside of this savings account and I got 7% interest on it? Then that means I make $700. And now I got $10,700. And then the next year, maybe I get another 7% and so forth. So that's the compound interest again, right? Compounding. Now, a lot of people don't know this, but when you pay a premium to an insurance company, and in this example, my premium, what I paid is $10,000. The insurance company themselves have two accounts. They have an investment account, and they also have a general account. Now, this investment account that they make about 15%, whereas in this general account, they only make about 4%. Okay. So when I pay this premium, or when you pay this premium of $10,000, that money is going into the insurance company's investment account. They're making 15% easily on it. And at most, they got to pay us 10%, but on average, it's about 7%, right? I want everybody to follow the money. Follow the money. Matter of fact, let me write that up top. If you don't learn nothing else today, follow the money. All right. Now, this general account is a lot different than the investment account. Okay. The investment account, we have no control over. We pay a premium, the insurance company takes it, and they can invest in whatever they want to invest in. That's their business. All right. Now, this general account is legally mandated. It's actually legally required to be only invested in safe and liquid assets. Anybody want to guess what the safest and most liquid asset is currently?
Right. Treasury bills.
Yep. T-bills. Bonds. Yep. Yep. So those are all cash equivalents. So let's just call it cash. So insurance companies have a huge general account portfolio that they're legally required to keep on cash. Why are they mandated to keep an account full of cash reserves? Well, let's think about it. You remember that life insurance policy we talked about earlier that AJ bought for $500,000?
For payout.
Yeah. That is actually an asset for AJ and his family. Why is that an asset? Because he signed a contract, the insurance company signed a contract that said if he pays a certain amount of premium, and if AJ dies when that policy is in force, they need to pay out $500,000 to his beneficiaries. Now, do they know when AJ's gonna die or pass away? No. Heck no. It could be tomorrow. It's gonna be 50 years from now, 60 years from now, right? So because they have that asset that they're contractually obligated to, that is a what for them?
Liability.
Liability. Let me move that up a little bit. You guys can't even see that. It's a liability. And so if you think about it from the insurance company's perspective, an insurance contract is nothing more than a promise. It is literally a promise to pay. So what happens when people break their promises and don't pay? Then you lose faith and credibility. There you go. Exactly. Exactly. So not just the insurance company, but the insurance industry as a whole cannot afford to have an insurance company not pay out its claims. And so because of that, they are mandated to have this cash in reserve at all times. This is money they can't spend if they wanted to, because it's set aside for those death benefits. Now, this $500,000, we know that it gets paid from their general account. But before that $500,000 is in this account, and they'll say they're going to issue AJ this insurance policy, they actually have to liquidate some assets. There's actually a reserve requirement. Typically, it's 10 to 30% of that death benefit needs to be set aside and reserved in cash for AJ's future death benefit, right? So let's just say we use 30 in this example. Okay. What that would mean is that they would need to take about $150,000 from their investment account, and then they got to shift this money over here. And now it's sitting in their general account. All right, family, I know we got a bunch of smart people on the call here, a bunch of us, right? If this was your account, you had one account paying you 15% and another account paying you 4%, would you want to take money from the 15% account and move it over into the 4% account?
No. Absolutely not.
Absolutely not. Why not?
You're losing money.
Never.
You're losing money, right? You guys remember the first thing I talked about today? The premium. The cost of insurance. The cost of insurance. If we look at this is 11% less by making that transaction, right? So AJ comes by this $500,000 insurance policy. They now have to liquidate $150,000 from their investment account, shift it over into their general account. Now they're out about 11% by giving that contract to AJ, right? So who pays for it? AJ pays for it.
Let's switch over to AJ.
Yeah. Now AJ is paying something called the cost of insurance because he is paying for that. He's paying for that death benefit. Do you remember what I said earlier? He's buying money. We are buying money. That's literally what we're doing. All right. Now, that's where the cost comes from. So when you guys are like looking at cost and fees and everything like that, there's a lot of administrative stuff that goes in the background of insurance companies. That's why there is a cost of insurance, because they have to calculate how much the premium that they got to collect in order to be able to make up for that loss that they just took by issuing out the contract. Because think about it, they are anticipating that AJ is going to be paying this premium for the next 40 years. So they're going to be able to make up that money that they initially lost on it. You guys follow me?
Yep.
Yep.
Yes.
All right. So let's just say, let's go back up to the top. Okay. Because this is really the most important piece of this whole account. All right. We got $10,000 sitting here in savings. It's earning 7%. As long as it stays in the account, it's going to earn 7%. But typically, a problem or something like that will come up, right? And all problems that I know of, they cost money, right? It's a bill. Y'all feel me on that?
Yes, sir.
Problems are usually
You know it.
have a price tag associated with them as some way or another, right?
Right.
And so if we think about our savings account, okay, how do we go about getting money out of our savings account? We just, either go on our app or we, Venmo or something like that. We transfer it, we do something, but typically all that means is we're withdrawing money from our account. So what happens in a traditional account is you would take the 10 grand from the savings account. You would use that money to pay your bills, right? So now you don't have the problem anymore, but now you got a big problem. You got no money left. So what happens when we make 7% on nothing?
Nothing from nothing leaves nothing.
Nothing from nothing means
Zero.
nothing.
Yeah.
Exactly. So I want you guys to think about it. Every time you spend money, that is what you're doing. That is what you're doing. Because I want you guys to think deep about it, right? If we would have left this 10 grand in the account for the entire year and made $700 on it, or got 7% interest, we would have made $700 on it. But because we had to spend it, we make nothing, which coincidentally means it cost us $700. Does that make sense?
Yes, sir. Opportunity.
Yes, it does. Yes, it does.
Opportunity cost. Every time we spend money, that is what we're doing. Literally every time. Okay. Now, this is what you can do with an insurance policy. Okay. You have the option to withdraw your cash just like you would in a bank account. But remember what I said, follow the money. I don't want you to think these guys are doing this for our benefit. Insurance companies are in the money-making business. They're a financial institution. Think about it. AJ, if you had 10 grand in your account and you wanted to withdraw it to go pay your bills and solve your problems, is that good or bad for the insurance company? Let me ask it another way. When we pay this premium, where is that $10,000 sitting in the insurance company's account? The investment account or the general?
Investment account.
Investment account making 15%. So
if
what
I'm
happens
taking from it, I'm taking from it too. They don't want my hands in my own pot or what seems like my own pot.
Yeah,
it's really theirs.
Yeah, there you go. Because now they losing on it. It's the same cost for them. It's the same opportunity cost, right? So this is the alternate scenario that the insurance company presents. You remember this general account? It only makes them about 4%. It has to be number one in safe and liquid assets. The only other thing that they're allowed to do with that account is loan it. And who can they loan it to? If you guys had to guess.
Yeah.
Insurance.
Policyholders.
Oh, yeah. Those policyholders.
And they hit you with the you paying yourself back, right?
I wouldn't even say you paying yourself.
No, but that's what they tell you.
Yeah.
That's what they tell you.
Yeah. I would even say you paying yourself in advance. So think about this, right? Because a lot of us hear this word loan and get scared because every loan that we take and we got to pay it back. That only happens when you borrow money that you don't have, right? If you borrow 100,000 from the bank, they gave you 100,000, you have to pay that back, right? But let's say if you had 100,000 of your own cash and you told yourself you were going to pay yourself back. I know we done that before. I got to take this money out of my savings account. I'm going to put it back in there.
Right.
Everybody didn't do that. Come on now.
Right.
I got a checking and a savings. So I'm gonna take it out of my savings, but I'm gonna put it back in there with the money from my checking when I get it.
Right. So we're gonna change the psychology. We're gonna take our cash, we're gonna borrow it. Okay. We're gonna borrow it from the insurance company, this 10 grand, and use that money to co-pay the bills, right? Or solve that problem. All we're doing is paying back this 4% interest on it because they need to collect it in order to be able to insure not just your death benefit, but everybody's death benefits of the company. All right. So let's think about it real quick. If you have money in one account paying you 7% a year, and you borrow money from a different account that only costs you 4% a year to borrow it, then that means you're only paying $400 of interest to borrow that money. Which means what? You just created a
You
positive.
still up.
You still up. Now, and this is kind of where people get lost. That's not just a $300 profit. We now got this 300 over here. We now have $10,300 in this account, compounding and growing at 7% for the next year, not 300. All right. Because we never spend the money, it never leaves the account. The interest gets added into the savings account portion, and we get to still compound on that full amount like that. Next place the next place that most people's mind goes to is, what about this 10,000? I got to spend it back or pay it back, right? Remember, we bought a $500,000 asset, an invisible asset. It's no different than buying a house that costs that much. What happens when you borrow against your house? Like in a HELOC, you got to pay it back, right? Say that one more time.
I was saying, does the value decrease?
The value decreases. Yep, the value decreases. This value of the death benefit will go down by the amount of the cost of the loans.
Let me take out 500,000 there. Let me get the 500,000 loan.
Yeah, 500,000 loan. Now here's the catch. You got to have 500,000 in cash in your account.
Exactly.
Gotcha.
And see,
Okay.
this is where I don't even think that people get lost. I think they get scared because I think they understand it. You know, family, talk to us. Like, look, you know what we do here. Engagement is important. If you understand what's happening, you know, sevens to let us know. But I don't think you're lost. Like this group, this community, I told you, this is a curious group.
So
they want to know.
I got a question that may help somebody. It's going to help me because it's
to follow you, AJ.
In terms of, because I know,
You two, go ahead.
I know some of us may be familiar with how the 401k works. You know, where you got the money set in there and then you can borrow, you know, in essence, borrow from yourself in a 401k. If you could kind of touch on the similarities in those processes, I think that may help somebody, because I think some of us are probably a little bit more familiar with that, you know, borrowing from a 401k versus going to get a traditional personal loan, and how that's, you know, the payout and paying yourself back, and, you know, kind of compare those two if you can.
Oh man, that's a dope question. Hey, let me see what James got. Let's see if we can combine it, because I know both of y'all feel like I understand how you think, but let's see what James got, and it may be something that we can combine.
See, I know where people's minds are going. Like, how can I borrow it? If I borrow it, they think it's gone. And the problem, like, it's not like it is like a savings account, but when you borrow against you withdraw $10,000, you have no other asset. So you're not borrowing from your personal policy, you're borrowing from the insurance company in the form of a loan. And that way your $10,000 gets an opportunity to grow uninterrupted.
Yes.
Exactly. So Brandon, you want to flush that out?
Yeah, let's flush it, because if we're talking about 401k, right? It's very similar, right? That's the only other account that will work similar to this. However, if we talk about borrowing money from our 401k, right? Let's say if we did, let's say if I had 100 grand here, and this was my 401k.
Hey, can I ask you one question?
Tax code is different. Who we got asking the question?
This is Antonio.
Antonio,
I was reading something about the insurance, the whole life insurance, and borrowing against it. Is there and I heard a term of overstacking. Is that a term that that applies to this thing too? You can overstack it?
I'm not sure what overstacking means. Does that sound like it sounds like overfunding?
Yeah, that's what I was.
Yeah. That's the same thing, equivalent to overfunding it.
Yeah, any insurance policy that is, if you're trying to save money in it, it needs to be overfunded, meaning you want to buy the minimum insurance based on your premium. So you never want to say how much is the insurance. You want to say, all right, I got 10,000, 15,000, 20,000, whatever. What's the minimum insurance amount for that premium? For example, in this account, let's say this was 100,000 of premium in the insurance policy. Premium here. This is the same thing over here. 401k, when you pay into it, that's premium. You're investing, right? Let's say if you borrow money from a 401k, the max you can borrow is 50% of the value up to 50K. All right. This loan has to be paid back typically between 6 to 7% interest. And you got to pay it back within 5 years. If you don't pay it back, or if you quit, or if you get fired, then that immediately triggers taxes and penalties if you're under 59 and a half. But the taxes are going to be either way. But if you're under 59 and a half, there's a 10% penalty on that amount, right? Whereas if we look over on the insurance, let's take the same 100 grand with different tax treatment, different rules. Now there is no max on what I can borrow. I can borrow what I have in cash value. Typically, you never want to borrow more than 95% of what you have in cash value. So let's say if I wanted to borrow 95,000, right? I'll borrow that. I don't have to ever pay it back. Right? You don't ever have to pay it back because it's literally money that you already paid to borrow. It's secured. Whereas if you borrow from a 401k, that's the Fidelity actually using your account as collateral, and you're borrowing their money, right? We got no security, because if the market dips on a 401k, that's why has anybody ever borrowed or withdrawn from their 401k and you get that screen that pops up and it says, look, this is what your account's going to look like. If you take out X amount of dollars, this is how much money it could cost you over the next.
Very familiar with it.
Yeah.
Exactly. That's why we never want to, because they don't want you to interrupt the growth of the account. The beauty with life insurance is, even though you're borrowing out the money never leaves the account. You're still getting credit, just like it never left. You're just using it as collateral. It's the difference between buying your house and let's say if you needed cash. Let's do another example. Let's say you got a house. Let's say this house is worth 100 grand. And let's say you needed 80 grand for an emergency. Okay. And you had nowhere to, this is the only place, the only asset that you had was this house that was worth 100,000. You got two options. You can sell it, right? But if you in this type of situation where you're trying to sell it short, sell it quick, you're not going to get what the house is worth. Maybe you get 80 grand. But now you lose the house. You don't have the house anymore. So how do you get your money back after you spend this money? You don't, right? But then let's say if we look on the separate side, right? If I was to take another house that was worth 100,000 and I needed 80,000 to go cover an emergency, and let's say I got good credit, then I can now use my house as collateral and borrow against it, right? So now I'm gonna take a loan out or open up a HELOC, right, of 80,000. Right now I'm using this 80 grand to go solve the emergency, but I still have what I got.
Still got the house.
Yep. So I got the cash, I solved the problem, and I got the house. And how much is the house worth still?
100 grand.
House still worth 100 grand, right? Exactly. The insurance is the house. We're building cash. We're building value in the insurance policy, just like we build value in a house. And instead of withdrawing our cash, we're just going to borrow against the asset. That's it. Rinse and repeat it over and over and over. But whenever you sell, you lose control of the asset, because now this 80 grand is gone. The house is gone. The house is still worth $1 million, but now somebody else has it, or 100,000. Now somebody else has it. Am I making sense?
Perfect.
Bro, you're making perfect sense. This is what we talk about. If you guys, if the family, is really tuned in, which I know they are, we talk about ownership and we talk about control. There's a difference. you own the policy, but now you're taking control of it. You're managing that policy, right? And so this is the invisible man that we talk about all the time. When you are operating in the space that Brandon, I see he just rolled bank, he about to really get there. When you're operating in this space, you're taking control. You're saying to yourself effectively, I'm responsible enough to systemically put into place opportunities for me to capitalize on the things that I naturally do in life. You got to do them anyway. It's no difference. It's no different than having a credit card that gives you cash back. You're taking this policy and you're using it in a similar way. I'm of the opinion that everything that gives me cash back in life, I want it. So, bro, it will not be long before me and my family come this way. We've been trying to figure it out. And again, I was on the call earlier tonight, but by no means did we even get this far, because most times you just don't. It's the traditional way of doing things. And yes, you can take care of your family, but if you can generate some income while taking care of your responsibilities, why not? So let's bring this thing home, B.
Right on, man. Hey, you preaching tonight, boy. You yeah. All right.
You talking to me.
All right. All right. So I want to kind of just break this down like real quick. Maybe this will help people view it another way. All right. You got money that comes into your bank account every single month, right? Every single month. Let's say it's 2,500. I'm just keep the number simple because I can do the 2,500 in my head. All right. Let's say that 2,000 of that is what you need for your bills, and the other 500 is really just kind of what you save. You either save in a bank account or you buy stocks or whatever. You just save it. Okay. So most people, what they'll do is when they get paid, they'll just write a check and they'll just go pay their bills of $2,000. And it literally passes through the bank. Okay. What we do with the insurance policy is this: before we go out and pay these bills, we're going to put that money in the savings account. How much does the savings account pay us on average per year?
Everybody say 7%.
7%.
There we go. 7% here. All right. So what's going to happen now is, let's say we got a February. You got March. We got April. We got May. All right. Just go 4 months, right? So what happens in May is or February, I'm gonna drop 2,500 here. So I'm literally paying that as a premium into my insurance policy. $2,500 a month is going towards a premium in the insurance contract. Everybody got me?
Gotcha.
Okay. All right. Now remember what I said, there's a difference between premium and how much the insurance costs. Premium is just what you pay. The cost is just the cost. Okay. So now I got this other account. This is called a loan account. Like your credit card is actually a loan account. It's a revolving line of credit. That's all this is. It's a line of credit that the insurance company charges 4% a year to use. All right. So when I put 2,500 in my savings account on one side, I now immediately have this loan account available to me that I could take $2,000 and use that money to go pay my bills. I do the same thing in March. Same thing in April. Same thing in May. And I'm paying my bills through this account. Every month, like clockwork.
Where you put the 500?
Yeah,
500 is going to be saved or invested.
Okay.
Right now, I'm glad you said that, because we got this savings account that pays us on average about 7% tax-free with no market risk. So for, let's say, emergency funds, I keep my savings in this account. For things that with higher return, I actually borrow money from this account and then I put it into the higher yielding investment, make my profit there, and then just put in more money back in here in the savings account. I'll get some more. Next time I come back, I'm gonna have.
Tell them one more time what you just did. Tell them one more time what you just did, because see, here's the cheat code. Here's the cheat code, y'all. And it's subtle. It's so subtle, but it's so impactful. Show them what you did again, Brandon. Like February, March, April, May. What effectively happens in those months, right? What's the spread right there?
Y'all got the spread. Y'all know. Y'all don't be shy now.
2,000.
When I think you're referring to the spread between the 7 and the 4, right?
Mm-hmm.
Mm-hmm.
You're earning 3%.
Mm-hmm. So you guys remember that example that I showed?
And you're doing what for it though, Courtney? Courtney, come back. What are you doing for the 3%?
You're earning 3% on that because it's also compounding over that period of time.
It's compounded, but what are you doing for it?
Nothing different, man.
Nothing. You're paying the same bills.
You're paying the same bill and nothing different.
And nothing different.
The same bills.
Oh, and on top of that, now you got insurance. You got permanent life insurance, right?
Yeah, sure.
So if you get sick, it pays you, because these have living benefits, long-term care, critical chronic illness. You have a heart attack, stroke, need a limb cut off, anything like that, you getting paid. If you get disabled and you can't perform your job, guess what? You're getting paid. And guess what else? When you die, your family's getting paid. Everybody say get paid.
Get paid.
Get paid.
Get paid.
Get paid.
And when you pay your bills, you get paid.
Get paid.
You get paid when you pay your bills. I really want people to understand. I really want people to understand the power in this. And I'll tell you, Brandon, like before James reached out, this is what me and James do. But we could talk till we're blue in the face. You need other people. James and I had a conversation. He's like, bro, this just makes too much sense. We were arguing on Saturdays about like videos you were putting out. He was like, yo, DJ, take a look at this video. Man, tell me this guy's wrong. I was like, bro, he's absolutely right. He's like, why are we not doing this? I'm like, we got to figure it out.
Yeah.
And credit to James, he's taking the steps to move towards being a first mover to figuring it out. And talking to him, look, I'm up next. But for those of you who are questioning, does this work? Is this real? This is very real. This is very real. This is as legal as it gets and as secretive as it gets, as it pertains to the secrets of the wealthy. You guys know that when we met, I told you, and BA, I didn't share this with you. One of my bosses told me that he only pays his bills 4 times a year. And I said, how you do that? I was 26 years old when he told me that. And he gave me the game. He said, I might as well get paid for paying. And he did it with credit cards. You're doing it with life insurance.
Yeah.
I want to do it with both.
Both. And so that leads to the next part. That's exactly what I do. All of my bills are paid via credit card every month.
Absolutely.
Like clockwork.
Man, bro.
My trip.
Got to.
Everything is paid via credit card. I got one statement that's due. I'm taking all of my income. As my income comes in my bank account, I send it here. Right?
Yeah.
What's the time for for me to pay the credit card out?
So you overfund this so that you can borrow whatever it is you need, because it's your money anyway. You take the spread, you save a little bit, you pay the bills, we rinse and repeat. Man, right. That's so fire.
That is literally it, guy. Hey, and this is important, right? This savings account side, this is the hardest part for people to grasp, because we only are taught to see things one way. We see money come in the account. Once it's spent, it's gone, right? As this money comes in, you're literally saving every dollar that comes into the account. It's a separate account, right? It's like having Bank of America. It's like you depositing your bank your money in Bank of America and they paying you 7% a year on it, and then you got an account that's linked with Wells Fargo, and they just letting you borrow money out of that account every time you put money in this account.
I think I'm following you. So if I could break it down, what you're saying is, listen, just because you're borrowing money, it decreases the overall value of the death benefit or the payout at the time that it would occur. But that money continues to grow unadulterated or unimpeded, like unimpeded to the quarterback. And until it's not a realized loss until you actually like, okay, you haven't paid this back and we're at this date, we're going to reduce this, because they have to operate under the pretenses that this is going to be paid. So it continues to grow at the amount that it was funded initially, right?
Look, it's going to continue to grow on every single dollar that comes into that account, even the interest, right? So check this out. If we did the math on both sides, 4 months in,
10,000 and 700 on the left, you got 320 on the right.
Okay, so we got 10,000 and 700.
Yeah.
To say interest, and this is just simple interest. Let's keep it simple, right? Plus 700.
Man, that's just 4 months.
Now you got $8,000 minus 4% cost.
320.
Right, so that gives us 320 minus 320 cost. All right, so if we did the math there, what do we got? These accounts have literally nothing to do with each other. They're separate accounts. One account you have money stacking, and the other account you got. In one account you have money stacking for you, in the other account you have money stacking against you. But the money stacking for you is paying you more than the money stacking against you, so it doesn't matter.
It's compounding faster.
Exactly.
Almost twice as fast.
Yep. I see somebody got Antonio, you got your hand raised.
Yeah. I was
one second, Antonio. I apologize, bro. One second. We had I didn't come in really quickly. We had a couple of sisters that had their hands up prior to you. So I want to be respectful to them. I think that might have been Crystal and someone else. Sis, if you're out there, why don't you, it might have been Deidre as well.
Oh, wait, hold up. Where can I see the hands at? I just seen the hand pop.
I can see it.
Oh, okay, got you.
I think I think it was Deidre.
Yeah, it's Dedra. It's Dedra, but yeah.
I apologize, Dedra.
No problem. No problem.
Definitely want to get it right.
Okay. So my question was, in this example, so you're not able to, so you're able to take out as soon as you put it in, or is there a time frame that it has to be in there?
Yeah, you can take it out as soon as you put it in, but there's a time frame, not necessarily a time frame from the insurance company, but actually it is from the insurance company. They need to be able to verify the transaction clears the bank account, right? So let's say if you send money to your insurance company today, there's about a 15-day window that they need to verify that transaction to make sure that like nothing bounces, right? So they usually won't process a loan until the 16th calendar day or the 15th calendar day that you made like a payment into the policy. Now you can expedite that if you can just prove that the payment posts in your account. So like, let's say if I need to buy something like really quick and I got just cash sitting in my account and I don't want to take my cash. Oh man, it's crazy how far we come. That whole concept, it changes everything, man. When you just are like, you got to pay for everything with credit and not your cash. I'll make a quick deposit into my insurance policy. And then once it posts, I'll send a screenshot of the transaction to the back end of the insurance company, and then they'll process the loan. And I can get it in 2 or 3 days, turnaround time in some cases.
So the money, does it go into an account, or you're taking it out of the insurance company has to send you the money? How does that part work?
So it literally goes like this. All right. You're going here from your bank to your insurance, and then you're taking a loan. That money's going direct deposit back into the same bank account or a different bank account.
Okay, thank you.
Yeah.
Yep, just a quick trend. It's a quick little, it's like a small step. It's so subtle because just that small little trick right there is powerful.
And that's non-taxable, y'all.
I want to show you guys something about the power of compounding your growth like that. Let's see if I can pull up here.
And while you pulling it up, I think we got Antonio. I think you're up next, brother. So you can come off mute.
Oh, okay. The question I had was, is that using the VUL or the index? Which one is that I'm using to do this?
We use the index to do this. We use the index to do this. Yep.
So basically, I'm paying like, say like my check is $2,000 every 2 weeks. So I'm just depositing that $2,000 into my insurance account, and whatever I need to pay my bills with that 2,000, I just borrow it from the other side of it. And like you said, my account each month, my account is growing $2,000, $4,000, $6,000, and so on and so on. But that money never, that money never depletes because it's just increasing in my my insurance. It's just making the value of my insurance go up.
Correct. Now, keep in mind, there's like cost of insurance and there's like those fees that come out when you make your premium. That's why next time I come, I want to show you guys like a spreadsheet and show you like an actual case study of a case that I did a couple months ago for that one. And then I could even just do some like special request case, so that way you can kind of line it up and see what it actually looks like long term. All right. Let's just say, for example, right? Let's say if your bills are let's say $3,000 a month. Okay, so we start with $3,000 as an initial investment, and then every month we're paying $3,000. And let's say we did that for 30.
Hey, Brandon, I apologize for cutting you off. I see the Queen has her hand up. Miss Stacy Fowler, please come off mute.
I'll wait till you finish his calculation, because
I know your mind. Where he's going, you're likely on the road there. So let's put it together. Go ahead.
Okay, so well, he switched the value. So basically, I heard Antonio say every 2 weeks. So in a year's time, that would be $52,000 that you put into the savings side of this vehicle at 7%, correct?
Correct.
And now you're saying, so basically every month he's putting in 4, but he's taking 3 out. So then there's 1,000 left, right? Kind of in this example that you're doing. So the spread is that 3% difference.
Yep.
Okay. So.
Oh, wait, when you say the 3% difference, are you meaning the difference between the money that was left in or the money that was taken out?
Say it again.
I said, when you say the difference, are you referring to the 3% that spread that on the money that was left in or the money that was taken out?
The money that was left in.
So you're getting 7% on the money that was left in.
Okay. Right.
And so really the way you want to think about it is the two separate accounts.
You pay that
because it's important even with compounding, something that compounds at 3% versus something that compounds at 7%, you're gonna get a completely different number, right? So 7% on that account minus 4% on this account. They are two separate accounts. Let's pretend they have nothing to do with each other.
Okay.
Nothing. When that money is coming over here, let's just say it's 1,000 every month. It's just coming in.
So that's yeah. Okay.
Now what happens on that right side over here? So that's what's happening. You're compounding at 7% on this side over here, the blue side. As far as the loans as they come out, let's say let's just say 900 is coming out. You're saving 100.
In terms of your fees. Okay.
Mm-hmm. Right. That's 4% on the 900, which is a separate account. Completely separate.
So the fees are only coming out on the 4% side, not the side that you're saving on.
Correct.
Okay.
Correct.
Stacey, also keep in mind that 900 is what you borrowing for yourself to pay your bills.
Mm-hmm.
Correct.
But the $1,000 never leaves the other
It's
account.
still on the other side. Right. It's
Right.
not moving. You're just doing the loan here with the
right.
Okay.
So how do you incorporate paying the loan back?
Yeah. Beg your pardon?
How do you incorporate paying the loan
I can
back?
take that, B.
Okay.
You don't
Antonio, the way you look at it is this is musical chairs, bro. This is a game of chess. This is musical chairs. So what you're doing on the 7% side, you're earning, right? We all agree that we're earning. And on the 4% side, we understand that we got to pay the cost to play the game. That's it. But we're covering the spread significantly there. And as it relates to your direct question, all that happens there is you refund the account. And here's how that works. And I know that
you got it now. You talking.
Yeah. The way that it works is you only get penalized if you don't refund the account. Other than that, they don't even consider it a loan. That's the beauty of this thing. You're taking a loan, yes, but it's your money. So it's not like you're going to the bank. So if you don't refund it, they say we're going to penalize you by decreasing the value of your payout. As long as you refund it, it doesn't matter, bro. Like, this is a cheat code to life. I am going to take advantage of this in a way that is unheard of. All my money going here.
I want to connect with you, bro, because I keep hearing the stuff with the AI that y'all got. That's been on my mind, bro. I need to.
Already said. Listen. Listen. You don't. Here's the thing, guys. Well, family. I know we're getting late in time, but we don't know what we don't know, and this is a introductory course to something that's much deeper. When James and I spoke about this, and I've even talked to AJ and Cousin Ed about it. Look, like I said, I got a lot of stuff on the wall that say I'm supposed to know a lot. I know what I don't know. I don't know this. As I begin to understand it, I'm able to talk about it a little bit more intelligently, but I'm also willing to yield the floor to those that are masters in this space. We have all come together to be better as a collective and be valuable to each other. I can wholeheartedly tell you that I'm going down this path. James is already going down. I know Dunny is going to do it. I know several other people will do it too. But here's the thing. Do it in the way that's most beneficial to you. This is not cookie cutter. And I think that's what, if you take anything away from what Brandon and Anthony is saying to you tonight, it's not that you have to do it one way. Is that you figure out a way that makes the most sense for you, but understand the numbers. Yeah. Get to the number. Mm-hmm. Once you get to the number, the formula works. Yeah. You just got to get to the number. Yeah. So my plan is to show up and get to the number. The formula works. So let's not work against each other. Let's not work against ourselves. Let's think about this. So Miss Stacy asked a dope question. Antonio, all of you have asked great questions. Here's what I would ask of you. Based on the information you've received tonight, what could you come back with in the next 24 to 72 hours that's going to change the way that you look at life, the way that you plan to do things, and how can we help you get there? And then we'll plug in the resources to make it happen, because this is what it's really all about. So yeah, I know I said a lot, but Brandon, Anthony, back to the two of you, man, to kind of take us home, and we'll close this one out. But we would love to have you back. I mean, love to have you. Miss Stacy, I think Miss Stacy has her hand up again. I apologize.
I just want to say one more thing.
Mhm.
So all the people on this call, if you have found yourself in debt, you need to do this system because the percentage and the rates are so much cheaper than your credit card rates with you being in debt. In terms of you're paying yourself and the percentage of the loan is like 20 points less than probably most of your credit cards. So you need to understand this. They need to come back and do this again with us and take us deeper so people can understand how you really begin to build your wealth and change the legacy of you and your family.
Yeah, I really want to do that. That's why I want to bring out that like an actual real life example, because like that's really where the power is, like putting in an application based off of like a specific person's like goal. Because like just what you said with the credit cards, you're paying a high interest rate on the credit card, right? And while you're paying it, you can't build wealth while you have debt, at least unsecured debt like that on one side, right?
Right.
We're actually able to transfer the debts from the credit card or from the mortgage, any debt. You're transferring that debt to the insurance company when you take out a loan from here to pay another debt. You're literally transferring the debt.
And there's no capital gains.
Man, it's what? No cap gains? None of that.
Oh my goodness.
Yeah, we got to go down a rabbit hole when y'all come back of how this works with multiple income households.
Oh yeah.
Being able to insure everybody and make this all work, at the same time. Destrian, James, this is now a requirement. This needs to happen before the end of Black History Month. We got to.
Hold on. I'm over here texting Destrian right now.
Yeah.
First of all, listen, everybody, thank you very much for staying this late. We definitely have never had
Look, we get up at 2:00 in the morning for money because we got the London coming. Look, staying awake for money is not hard to do. I think I can confidently say that for everybody.
It is a sacrifice, but first of all, we want to thank Brandon and Anthony for that sacrifice for coming to us. But I'm over here testing Destrian now about this, and hopefully we can probably get him back on a Saturday where we can have a full session with him.
Yeah.
So AJ, it goes back to your time. I was going to ask you offline, but we can have a Saturday school.
Man, y'all quit acting like we just whole bureaucratic organization. Y'all taking over a Saturday to talk more money.
There we go.
Y'all know we about it. I'm not going to say no to that. No.
Hey, B, listen.
It just mean I'm going to have to drink my coffee that morning. So
everybody's in the chat. Everybody's in the chat right now asking.
I do it now.
Can we do a Saturday?
B, I'm going to hit you offline. If you can do this Saturday, next Saturday, whatever.
Okay.
We do Saturday, but here's the thing. But it's gonna hurt you. We do 9 a.m. on Saturday morning.
Oh, so that's 6
a.m. Yeah, Carolyn.
Well, hold on, no, I got it.
We'll put Terrell in charge of a wake up call.
Let's do this to try to help him out. If we do it right after our Saturday school, we do it right after our Saturday school. We could do 10 o'clock.
We do a special time, but I'm investing in this because what I think that James saw when he saw this, he saw something that made sense that not only you can afford, you're already doing.
Exactly.
Just don't understand how to unlock it.
Or not, they didn't even know
what it was for me. Like
man.
When Rich showed me this, I said, "Time out. Wait a minute. What?"
Yeah, this is run that back, Turbo.
I said, "Wait a minute." What? I said, first of all, I ain't never seen an insurance policy where you can get your money out of it. Like
never, bro.
Like that, I ain't never seen that. So he had me at that point, and then when he showed me, and I'll never forget, like. We got software and tools now because we're in the beginning stages of like putting this stuff together. Like you see where it says like calculator, we got a calculator that makes projections. Before we had to use the basic illustration software with the insurance company's parameters, and the software ain't even designed to illustrate what we show. Like it ain't even like something that people are doing. Like when I say this is something unique, something special, I'm talking about less than 1% of 1% are doing this.
Bro, let me do this, right? Family, do me a favor. I want to peer pressure Brandon and Anthony. If you want them back, go ahead and drop them sevens in the chat. we need them back. We need them back, right?
Yeah.
So understanding that, allow myself, James, and Cousin Ed and Dunny to have the proper conversation. These are busy people, but we will have them come back. Hopefully we can get them back for Saturday. So our Saturdays are a vibe, bro. It's a whole vibe. We move cool. It's meant to be our weekend review, but we can definitely dedicate some time to go deeper on this. And I want to, because I told you I want this to be a relationship.
Right.
I think that the information that you have access to, the way that you teach it, it's unparalleled, man. And it's coming from a perspective of a person that didn't grow up in this business, but you feel like an industry vet, man. Like all of you do. The way you guys really come in, you care about the people. That's what we're about. And I don't know if you know, but we have a mantra. We trade, we serve, we support, and we repeat.
Oh, I like that.
They know.
Yeah,
they know what it is.
Right on. Yeah,
but there's no trader.
Let me
Go ahead, Donnie.
No, let me jump in. I definitely wanted to thank both you gentlemen, Brandon and Anthony. We talked before this, so I want to say thank you so much from the bottom of my heart, because I think that this information that you have presented to us is definitely invaluable, right? And I know a lot of people are still trying to digest it. There's some things that we still need to dive into. And so what I want to do, if we can, is let's put a pin in it. We're going to talk offline to get a definitely day and time for us to come back, because I want to make sure we're respecting everybody's time on here. I know we can go long, but I want to respect everybody's time, right? But here's what we're going to do, family. It's 10:30 Central, 11:30 Eastern. We're going to go ahead and call it a night, but get ready, because keep your ears glued to the chat. We're going to put in our very next meeting with them, and it's watch the flow. You guys are going to be able to get your questions answered. We're going to go a little bit more in depth, and we're gonna make, as James say, make it make sense, right? We're going to break it down so that everybody understands it. It's going to be so simple, and then he's going to come on with other examples, real life examples, and you'll get a chance to ask questions. So with that, James, let me pass it to you and closing us out.
Yeah, no, I just want to thank you, Brandon and Anthony, for spending your evening with us, man. We don't take this time for granted. You know, time is so valuable. You can't make more of it, but you've imparted a lot of wisdom. You've at least sparked the interest of so many people who, without you coming on our show, on our Zoom, they would have no knowledge of it. As you've already so eloquently put it, less than 0.5% even are aware of this information. Yeah. And information for information's sake is useless. It's the application thereof. So we're so gracious for your time, thankful for your time. And if you could bless us again, and this time we'll probably have a format where maybe we'll hold the Q&A and you just kind of go through it. Gotcha. And then we'll start to stagger the questions in the order in which they were received. That way we can get everybody's questions answered. But more importantly, you can kind of cover the way you do it, man, is brilliant. So definitely come on back with us, man. And if for those who might want to follow Brandon and Anthony, we'll make sure we'll put that into the chat rooms.